Okay, we're going to go ahead and get started. Thank you everyone for joining us for today's webinar where we will be discussing credit reporting basics. This webinar is being recorded. All attendees will receive a follow-up email with today's recording and presentation deck within a week. All participants have been muted, so please use the Q&A box for any questions and we will answer them at the end. Your presenter today is Rod Griffin. He is the Senior Director of Consumer Education and Advocacy at Experian. And with that, I'd like to now hand it off to Rod. Welcome, Rod.
Thank you so much, and thank you everyone for joining us today. I have a lot of ground to cover about credit reports and credit scores, so I'll talk fast. I apologize if I start to sound like an auctioneer. I'll try to slow it down, but want to help you better understand credit reporting and credit scoring. Just a little bit more about me. I do lead Experian's North America Consumer Education and Advocacy programs. I've been with the company now a little over 27 years, so I've watched it grow and evolve, and I watch credit reporting and scoring evolve over time as well. So hope to be able to share some information that's going to be helpful for you today to be more financially successful, more financially healthy, better understand how to use your credit scores and your credit reports to do that. Start with a simple concept, and what we're really here about credit reports. This is about credit reports and credit scores and why they matter. It's important to understand that credit is a privilege you earn. It's not a right that you have. That's often misunderstood. And so you build credit with the choices you make and the decisions you make regarding how you use it. I want to help you understand how to do that so credit works to your advantage, and really make sure that you're building a credit history that's going to be there to help you and work for you, not be a barrier to access to financial services and tools and resources that can help you lead a better financial life. We want it to be a tool in your financial toolbox that can give you opportunity and help you build a brighter future. So the first thing is credit's a choice, and you make choices about how you use credit every day, and the choices you make can help you be more successful. In order to make those choices, you have to start with the basic definition. You need to understand what credit is, and it's simply obtaining goods or services and then paying for them at a later date under agreed upon terms in a contract. Today, credit, when we think of it, includes things we've always kind of considered being credit, things like credit cards or mortgages or car loans. But today, it could also be some very different things. It could be cable television bills or streaming service bills, your cell phone bills, utility bills for things like natural gas or water or electricity, your rent payments, and even insurance payments today can be part of a credit report and could help build a positive credit history. I'll talk about how you can have that information reported yourself, and the positive information in just a bit. Most importantly, your credit will serve as your financial references. They're kind of like references on a resume. You want them to be good, obviously. When you go to get a job, you want your resume references to say that you would be a great employee. When you walk into a bank or a credit union or go online and apply for credit, you want your credit report to say, hey, you should open this account for this person. You should make that loan because they're going to be reliable in repaying it. We want it to be positive references. And I'll talk about how you get there with your credit. Another really important concept is that credit and debt aren't the same thing, and that's often misunderstood. You can actually have credit and not have any debt, and that's kind of the ideal situation. So think about it this way. If you have a credit card and you make purchases with that credit card during the month, and then you pay the balance in full, you won't have any debt. So you don't have a balance on the card because you paid it in full. But as you've used that card, you might get cash back for those charges. You might get discounts on purchases. Perhaps you would get an insurance discount or airline miles or points toward future purchases. Those are all financial advantages for you. So if you're using your credit well and paying the balance in full each month, you're getting a financial advantage. It's giving you a financial gain without carrying debt. And that's what we want you to think about. Credit's not equal to debt. They're not the same thing. They're clearly very closely related, but they're not the same thing. You can have credit, but not have debt. You cannot have debt and not have credit, though. So you want to make sure that you're using credit as a financial tool Debt can become the financial problem. So where does that credit come from? How do they know how much credit you have or how much debt you have? Who's collecting that information to create a credit report? Well, there are three national credit reporting companies, Experian, Equifax, and TransUnion. We all collect and store information. We compete, kind of like the car companies do. If you think of General Motors and Ford and Chrysler, for example, they build cars. They usually have four wheels, a steering wheel, an engine, but they each do those things just a little bit differently. And the same thing's true for us. What we try to compete on is the accuracy of the information we have, the completeness of that information, and how well it can help you gain access to financial resources and can help businesses manage risk so that they can reduce cost and pass those savings on to you. We have today a national credit reporting system. In the past, if you lived in a community, all of your credit was based on relationships with those merchants in that community. So where you shopped, if they offered credit, you would have credit there. If you moved from that community to another town or city, you lost access to credit. That's no longer the case. Today, because we have a national credit reporting system, if you move from New York to Los Angeles, your credit still goes with you. So when you move from one city to another, you can get an apartment. You can perhaps have it play a role in getting a job, although your credit scores never have a role in employment purposes. That's a common myth. I'll talk more about that as well. But your credit report might play a role in the job you're moving for. You may be able to buy a car. You may use credit to furnish that new house or apartment, buy the house. So your credit's there to work for you to help establish your life in that new community. Because we have a national credit reporting system, it's also important to know that the reason you can access instant credit, for example, if you go online and apply, you can get approved right away, or nearly instant today. If you go to buy a car, you can be approved and you can drive off the lot in a matter of a few hours, is because we have a national credit reporting system that helps businesses identify the likelihood that you'll repay that debt as agreed and can approve that loan right away. Our national credit reporting system also has resulted in those who live here having access to the lowest cost credit in the world. In other parts of the world, average credit card rates today are somewhere close to 30%. In the US, they're down around 23 or 24%, which isn't great. They used to be more like 16 or 17%. They've gone up somewhat, but they're still lower than other parts of the world. The same thing's true about buying a house. Houses are clearly very expensive, but in the US, interest rates are somewhere in the neighborhood of 6% today. In other parts of the world, they're considerably higher, and the process of buying home is considerably more complex and expensive. So because we're able to share information and connect consumers with businesses, you're able to qualify for credit and pay less for it. I mentioned that credit's available nationwide. You can move from one place to another and not lose access to it. You can use credit for just about anything. So when you think about credit being widespread in terms of availability, you can use it to rent that new apartment or buy that new house when you move, and you could put in, use credit to buy an orange couch and green carpet and purple curtains if you want to, whatever you wanted to do. I'd recommend that, obviously, but you could, and it will be there to work for you. Most important and least understood is that your credit report should be used like an account management tool. Just like you would use a bank statement each month or a credit card statement to know what you owe on that credit card and whether your payments are being made, you should get your credit report, know what's in it, because it could, for example, tip you off that you're a victim of fraud and help you respond to that and help protect your identity. It can help you identify accounts that perhaps you had forgotten about that are open and active. I've known people who have had a credit card, put it in a drawer, and a couple of years later come back, get their credit report and realize they still have that account, but they had forgotten all about it, and can decide whether or not they want to keep it active, maybe close it, decide what they want to do with it. So check that credit report, know what's in it. It's free. There's really no reason to pay for a credit report. You can get it once a week through annualcreditreport.com. And I'll say that again. So you can get a credit report from each of the national credit reporting companies once a week under our policies from annualcreditreport.com. You can enroll in monitoring services and other kinds of free services to get reports. So know what's in that credit report, use it as a financial tool. You should know exactly what Provident's going to see when you walk in the door and apply for a loan, and know exactly what they'll be looking at so that you know exactly what decision they'll make. You can know exactly what they know, and actually a little bit more, because we provide additional inquiry information and things in your report that they don't get. So check that credit report, know what's in it. As we go along too, I should say there is a Q&A section. So if you have questions, please enter them there. We'll come back to them at the end. And we have a chat box that you can use as well. Fair warning, I'm going to have a quiz, as a few quizzes as we go along. Would love to have you participate. And so enter your answers in the chat box. I'll tell you when. So we know where credit reports come from, who maintains them. What are they and why are they so important? Well, your personal credit report includes a record of your financial accounts and obligations, and the identifying information is associated with them. That identifying information is really important. I'll talk in detail about what's in a report in just a moment. We sometimes call it a credit file or a credit history, your credit report. They're all the same thing, really. And internally at Experian, if you're talking to people who work with the computers, they will call them a credit file, and they would tell you when it's a credit file is when it's just in the computer. It's a credit report when it's presented to the consumer online or printed, but it's the same information. It's just where it happens to be stored at the moment. When I talk to people about their credit history or their credit report or credit file, I'm talking about the same thing. Lenders use credit reports and scores to gauge the likelihood that you will repay a loan as agreed, that you won't default on that loan. So it's a critical tool used to manage lending risk. That makes it incredibly important to you as an individual consumer. A strong credit history enables you to get credit cards or home loans or car loans, as well as other services that you may not think about. Things like getting a new cell phone, because they're really expensive today. They will check your credit report. When you rent an apartment, the leasing company may review your credit history as part of their leasing agreement process and verification process. Utility companies may look at a credit report when you're applying for new utility service for that new apartment or that new home, and help them determine the rates for security deposits or those sorts of things. So they'll check your credit report. We don't always think about those things. So it's not just about the loans or credit cards. You might also see credit reports used for employment purposes. If you're applying for a job or a promotion, they may check a credit report. Again, they don't check credit scores. They never get credit scores, but your credit report, especially if you're in a position managing a company's money, they may check that report. Again, your credit report serves as your financial references to the companies you want to do business with. So if you have strong references, you'll be able to get the credit you need when you need it at the rates you want to pay. And that's what we really want people to be able to do. Oh, did I go too far? I did. So where does that credit report come from? I mean, how does it get started? We know where it's, who maintains them. We know what's important. People often ask me when they have a new child, a new baby, when can I get my credit report? I just got their social security number. I'd like you to send me their credit report too. Now I tell them, I hope we can't, because they should not have a credit report at that point. You don't get issued a credit report when you're born like you get a social security number. A credit report for most people is established when you first open your first new credit account, usually in your late teens, early 20s for most people. You'll apply for a credit card, or you'll apply for a car loan, something like that. At the end of the first month, you pay the lender. The lender then updates its records. And at that point, usually 30 to 45 days after you open the account, it will be reported to Experian, and we will create a credit report for you, because there's something then to report, a payment that you've made. We hope you've made the payment anyway, the first one, and we'll add that account to your credit report. Over time, that cycle will continue, and at some point you'll apply for a new account. That potential new lender will look at your credit history and say, yeah, you paid your first lender well, we'll open an account too. And at the end of that first billing cycle, you'll pay that lender. That lender will update their records. They will then report that account to Experian, and now two accounts will appear in your credit report. That's the historic way that credit reports have been established. And continues to be the most common way. I'll talk about a way that you may establish a credit report if you don't already have one, and things that you can add proactively again in just a moment. But the credit cycle is pretty straightforward. Each month you make a payment, that lender updates their records and so on, and the accounts get added over time. Our role as a credit reporting company at Experian, though, is often misunderstood. People think all sorts of things about what they think we do with credit reports. They think that we make lending decisions. We don't. They think that we determine whether a person has good credit or bad credit. We don't. That's up to the lender. The lender determines whether the credit that you have meets their criteria. People think that credit reporting companies score the credit. We don't. Credit scoring is a secondary or a different process altogether. It's a tool that's used to evaluate the information in the report. We don't actually, as a credit bureau, score credit reports. Scores are applied. I'll talk again about that as well, and where they come from. But credit scores are not part of credit report. Our role really is to act kind of like a library. We collect and store information from thousands of sources. We update that information continuously and store it in a way that a lender can check out, kind of like if you have a library card and you check out a book from a library, to help them evaluate the likelihood that a person will pay a debt as agreed. We don't edit the information. We don't change it in any way. Our role is to accurately reflect what lenders tell us is in their records. Now, if a lender reports 100,000 accounts and all of them are 90 days late, we're going to go back and say, hey, that doesn't make sense, that you wouldn't be in business. So, anomalies or things that aren't logical, we would alert the source of and say something's wrong. But we wouldn't go into, say, Rod Griffin's credit report and say, yeah, that account should be late because he everything else is paid on time, so that one probably wrong, probably he's late. We don't make those determinations. If the lender says it's paid on time, and it wouldn't be late in my case. I always pay my bills on time working for Experian. That's kind of important if I'm going to talk to all of you about it. But we don't go into credit reports and edit the information any more than a library would edit Shakespeare because it's too hard to read. So we store information so that it can be accessed if the lender has a library card, if they have what's called a permissible purpose under federal law. And those purposes are very limited. So here's my first quiz for all of you. And you can put your answer in the chat if you'd like. Which of the following is not a permissible purpose for getting a person's credit report? A, pre-approved offers of credit. B, underwriting insurance. C, test driving a new car. Or D, eligibility for a government license. Which one of those would not allow a business to request your credit report? Anybody care to guess? Nobody jumping right in. We'll give it just a second longer, and if not, I'll give you the answer. It'll be a quiet bunch today. All right, so the answer is that test driving a new car is not a permissible purpose. Making pre-approved offers of credit is, so they can, if you get a pre-approved offer, your credit report's been reviewed. Underwriting insurance, if you're applying for a new insurance policy, they're checking your credit report to help them determine whether you'll be able to pay that premium on time, or the likelihood that you may make a financial claim. They're not predicting that you have a wreck. But test driving a new car is not a permissible purpose. If you went to the local Ferrari dealership, if you have one of those, where I live, we don't have a Ferrari dealership. But if you did and said, hey, I want to drive that new Ferrari, test drive it, and the dealer says, okay, I'll get the keys, and you drive around and say, thank you, enjoyed it, and leave, they do not have a permissible purpose to check your credit report. If you said during that drive, how much does this car cost? Now they do, because you've started a financial discussion. You've indicated a potential interest in buying that car. And so then they could check your credit report. But just test driving it isn't a permissible purpose. And eligibility for certain government licenses is also a permissible purpose. These are those permissible purposes. These are the only reasons that a business can get your credit report. To open or manage credit accounts kind of makes sense. to make pre-approved offers of credit. So if you've gotten those, you will recognize them. You can always say no. The most powerful word in credit is no. 2 little letters, sometimes hard to say. For employment purposes, employers must get written permission from you first. That's the only time written permission is specifically required to get your credit report. And they never get credit scores. We do not provide employers credit scores for making an employment decision. They also get a limited version of your credit report. We remove anything that would violate Equal Employment Opportunity Act regulations, for example. So that isn't part of a credit report that they would receive. So it's a limited, what we call truncated version of a credit report. For underwriting insurance, I mentioned they're looking at whether you'll be able to pay that premium on time, which is very much like a monthly payment for a loan, or the likelihood you'll make a financial claim. They're not predicting the likelihood you'll have a car wreck. Some people have said that to me. I was like, no, that's not what they're really looking at. They're looking at the financial risk there. A business transaction initiated by the consumer simply means you've applied for credit. And I'll back up to insurance. There are a number of states who are have prohibited the use of credit reports for insurance underwriting. So I'm trying to remember if California is one. I think so. So you may not see that at all. Court order or federal grand jury subpoena, of course, we're going to respond to. If we get a subpoena for a person's credit report, we're going to comply with that law and regulation. Evaluation of risk of an investor. So if you went to a startup and said, I want to invest $3 million in your startup, they could look at your credit report and say that you have $6 million in debt you need to pay first. So they can check your credit report. Eligibility for certain government licenses and things like security clearances as well are a permissible purpose for checking credit reports. And disclosure to you as a consumer. You can get your own credit report as often as you like. It will not affect lending decisions, will not affect credit scores in any way. So do not be afraid to get your credit report. It doesn't affect lending decisions, doesn't hurt your credit scores. So we've talked about where credit reports come from, how they're established, what your role is in that process in opening accounts. But then who are the players in that cycle? Who's using them? Well, it starts with the credit reporting companies themselves, of course, Experian, TransUnion, and Equifax. We collect and store that information. Lenders then obtain those credit reports to help them determine the risk associated with doing business with you, the risk that you'll default on a loan. Risk score modelers are the companies that I suspect most of you know at least some of the names of, at least one of them, but people often don't realize are not the same as the credit reporting companies. So FICO, Fair Isaac Corporation, now FICO, is a credit score modeler. They develop the scoring algorithms, the formulas that are used to calculate credit scores. So FICO scores are called FICO scores because they are FICO's scores. They're proprietary to them. VantageScore is another well-known credit score modeler or developer. A lot of national banks have their own credit scoring company or credit scoring divisions or groups within the banks that they create their own custom scores. And there are others. Credit Union National Association has developed a score, or did in the past, for credit unions to use. I'll talk more about why there are different scores in a moment. But the scoring companies and scores are separate from the credit bureaus. And the government, we are, of course, very heavily regulated at both the federal and state level, as well as in California, one county had a law at one time as well. So and it covers everything from what can be in a credit report, who can access it and under what circumstances, to if someone asks for your credit report, a lender, for example, what typeface we have to use if it's printed and what font or what size that typeface needs to be. So very heavily regulated. But you, of course, are at the center of that cycle. You decide how much credit you're going to use, when you're going to apply for credit, how you're going to make those payments. So you can control the information that's in your credit report based on the decisions you make about how you choose to use credit and how often you plan to apply, how many accounts you choose to carry, how many credit cards do you have. Those kinds of decisions are all up to you. And you are the first source of information that goes into a credit report. When you apply for credit, you'll see an application. We always encourage you to be thorough and complete and consistent in the way that you complete applications, because the identifying information from that application is the first information that's added to your credit report. So if you are applying, maybe you'll use your full given name as it appears on your birth certificate, or maybe you have a nickname or a shortened version of your name that you use all the time. It's a good idea to be consistent with that. Let's use my dad as an example. He could never decide what his name was. His name was Adrian Dale Griffin. That was on the credit report. But so was Adrian Griffin and Dale Griffin and A.D. Griffin and A. Dale Griffin. And did I say Adrian D. Griffin? Were all part of his credit report because he used all of those names to apply for credit. Every year he would tell me, son, I just got my credit report. You should only have the correct name. With that, if you pick the one you want, that's the one that will be on your credit report. So being consistent is very helpful. And that's helpful to us because it will help us ensure that we have correct and accurate information in your credit report, match it fully. And it can be helpful to you because if there's a name you don't recognize that you've never used, it could be an indicator of fraud. So it helps you also keep track of the information in your report and make sure you know what's being reported is accurate. So that gets us to the information most people want to hear about. What exactly is in a credit report? Well, it's pretty simple. And the way to think about it is if it's not debt related, it's not part of the credit report. So one, you're identifying information. We need to know who you are because there are more than 220 million people with credit reports. And you are probably not the only person with your name. For example, I know there are other Rod Griffins out there. And one of them, when I first moved to Texas 28 years ago, was not good at paying his rent, apparently. And I had to verify who I was and that I wasn't that person. So there are others out there who have the same name. That's why identifying information is so important. And on your credit report, you will see your name, your address, your social security number, your date of birth. You may see previous addresses, and you may see a listing of employers that have been reported to Experian. The employer listing is not meant to be an the employment listing is not meant to be an employment history. We list the employers that have been included in your applications for credit and reported to us. That doesn't mean we'll have all of them. It's actually just used as an identifier to help a lender further match who you are, or, who you say you are. The reason is that today, for example, if you were to apply for a car loan, buy a car, you would list your current employer today. That car loan could last 4 or 5 or 6 or 7 years. And within that time frame, you might change jobs 2 or 3 times. And if you don't apply for credit during that time, none of those new employers would be reported to Experian. So the next time you apply, you would list them and they would be added. But if you're applying and you list those employers, the lender is going to look and say, yeah, I see 2 of the 3, so it's a stronger likelihood you are who you say you are. So it's not an employment history, it's an identifier that's added to your report. So one thing to understand. So I often get people saying, my employment history is not complete. It's not meant to be a history. So don't worry if you don't see all of your employers listed. The other thing to know is that on your credit report, we list every variation that's reported to us of your name, your address, your social security number. So if you use multiple names to apply for credit, you would see all of those listed. If there's a name you don't recognize, it's because someone has reported that as belonging to you and is associated with your other identifying information. We're going to show that because we don't know if you've used that name as to apply legitimately or not. It could be an indicator of fraud. So we're going to make sure it's listed. When it comes to social security numbers, we do not have access to Social Security Administration records to immediately match and say, this is the correct social security number. So if you have 10 accounts and 9 of them show the same social security number, we can probably assume that that's the correct social security number. And that 10th one is a variation, but it could be, and most likely when we see that, it's a typo or a transposed digit. So instead of 1, 2, 3, 4, it's listed as 1, 3, 2, 4. We're going to show that anyway, because if it isn't a social security number that belongs to you, again, it could be an indicator of fraud, and we're not going to guess. So we're going to list all of those variations. Same thing true of street addresses. So we list all of the identifying information that's reported as belonging to you by your lenders or lenders who are reporting an account for you. That's important because when you see the reports of inaccuracies in credit reports, and there are a couple of famous ones out there, and that are cited frequently, one from a very well-known publication, one from a consumer group. When you read the fine print, they say that 85% of the errors that are they counted as errors are variations in name, address, or social security numbers. Those are not errors. We list those on purpose so that you have that information and can respond to it if you need to. We can help you recover from fraud. I think it's important to understand. We're not perfect, but we're very, very accurate. And so when you see those variations, they're not errors. They're there to make sure that you have that information. Identifying information is not included in credit score calculations, so it doesn't affect your credit scores either. So it's important to have that. A lot about identifying information is really important to us. Account information, of course, is the heart of the credit report. That includes any type of credit account you might have, whether it's an installment loan, buy a couch and you pay for it over time, for example, an auto loan for a car, a mortgage, could be a credit card, or what we call a revolving account because you can carry balance from month to month, a charge account. So looks like a credit card, but you have to pay the balance in full each month. Those will be on the credit report. It will list the account type. It will list your association with that account. So are you the primary account holder? Are you a joint account holder? Are you an authorized user? Are you a co-borrower or co-signer? You'll see that listed with the account. You'll see for an installment loan, the principal loan amount or the loan amount that was made initially. You'll see your remaining balance. On a revolving account, like a credit card, you're going to see your credit limit. You're going to see your current balance. Most importantly, with each account, you're going to see whether or not your payment history is your payments are being made on time. So your payment history is going to be critical. So are your bills, each of them being paid on time, or are they late? And if they're late, how late are they? Are they 30 days late, 60 days late, 90 days late, etc. In your credit report, payments are reported every 30 days. Accounts are updated every 30 to 45 days. So it's monthly. If you have an account and the due date is today and you miss the payment, but you make that payment tomorrow, that will not affect your credit report. You wouldn't see a late payment. That doesn't mean that the lender might not charge a late fee or change an interest rate as a result of a late payment, but it wouldn't affect your credit report. For a payment to be late in credit reporting, your due date, if it's today, 30 days from now, the next due date, it still has to be late. And you miss a full billing cycle for a payment to be late. I think it's important to understand. So payment history is really important. And the balance to limit ratio on credit cards is really important as well when it comes to credit score. So I'll talk about that in just a bit. In your credit report, you will see bankruptcy public records. So if you have had to declare bankruptcy, you would see a Chapter 7 or a Chapter 13, and any account included in that bankruptcy should be updated to show included in bankruptcy with the status of the account. So you would see that as well. You may also see a list of inquiries in your credit report. An inquiry is simply a record of who has requested your credit history or your credit report. There are two types. The first are what we call hard inquiries. Those are inquiries that represent an application for new credit and may be shared with the lender because they indicate that there's a potential new debt that's unknown because there's no new account yet. And so it represents a bit of risk. So that's a hard inquiry. The other type of inquiry we call soft inquiries. Soft inquiries do not affect credit scores in any way. So you generally see very few hard inquiries. You may see a lot of soft inquiries because they include things like pre-approved credit offers, reviews of your own credit report by yourself, insurance purposes, employment purposes, those sorts of things. So they would show on your personal report. BNPL is changing things a bit because it represents a new debt. They're starting to report buy now, pay later loans or pay in four loans. We're not seeing very many, but as they do, we're listing them as what we call a soft inquiry, but the lender, so they don't affect credit scores, but we may notify the lender that there's an existing BNPL account because it does indicate risk. So they're somewhere in between kind of a hard inquiry or a soft inquiry. So that's something that you would see listed as what we see in inquiries that do not affect your credit scores. So BNPL is a bit unique and something that's still evolving with time. And of course, you would see dispute instructions. If you find something you believe is inaccurate, you need to contact us, or you're a victim of fraud, you'll see instructions to call us, write to us, or go online to dispute that information and help you get it updated and corrected. So pretty straightforward. So what's not in a credit report? The easy way to think about it is if it's not debt related, it's not part of a credit report. Oh, that's shifted a bit. Criminal background, we don't know if a person has things like arrest records, anything like that. We don't have medical information in a credit report. And everybody will stop me and say, but what about medical collections? And yes, we may have medical collections in your credit report, but we remove any information that would violate what's called HIPAA, the Health Insurance Privacy and Portability Act, HIPPA. And so we remove the name of the healthcare provider, any reference to the illness or treatment you have received, the contact information for that healthcare provider from the lender's report. They wouldn't see it. So the lender just sees medical collection. On your personal report, we would show you the name of the healthcare provider or the healthcare collector, as well as contact information, because you might need that. But we don't share any of that information with a lender or a business. It just says medical collection. The other thing that's no longer part of credit reports are most public records. With the exception of bankruptcy, we've removed all public records. So there are no tax liens, paid or unpaid. There are no civil judgments if you're sued or lose. There are no parking tickets. There are no library fines. And yes, when I started with Experian 27 years ago, we were still collecting library fines. So if you didn't return your library book, it could appear in your credit report. That's no longer the case. So if you have a library book that needs to go back, you can take it and don't worry about it. It's not going to affect your credit history. We also do not have any information about your buying habits or transaction data. What I mean by that is if you use a credit card to make a purchase, we don't know what you buy. We might see an increase reported in your balance, but we wouldn't see what exactly you purchased or where you made that charge. We have nothing about your assets in a credit report. So there's nothing about income or savings accounts or checking accounts or CDs or IRAs or 401ks. Lenders are looking at a credit report to help them determine your propensity to repay a debt or your likelihood you'll repay a debt as agreed. They look at your check stubs and your other assets and checking accounts and available cash, those sorts of things, using other tools, because they also want to know your ability to repay. But just because a person might have $1 million in cash in the bank doesn't mean that they'll use it to pay their bills on time. So they're looking at not only your ability to repay, when they get their credit report, they're looking at your propensity to repay, the likelihood you'll repay it, that is agreed. And credit scores are not part of a credit report. It's a very common misunderstanding. Credit scores are a separate process from credit reporting. They are a reflection of the information report at a moment in time. And I'll talk more about where credit scores come from in just a moment. Before I get to that, I mentioned that there are ways you can add new positive information like rent payments, cell phone bills, streaming services like Netflix or Hulu, utility bills like natural gas, water, and so on, or electricity to your credit report, and even insurance payments today. We have something we call Experian Boost. So if you go to experian.com/boost and you tell us, I have a electricity bill, a cell phone bill, and an insurance bill that I want to have added to my credit report. And this is the account I pay it through. So whether it's a checking account, a savings account, credit card, and give us permission to access once a month those accounts payments. We'll capture those payments and add them to your credit report. Only positive information. It's free and it's permission based. So you give us permission to do that. If you change your mind, you can tell us stop and we will. But we would add 4 different accounts to your credit report. We can capture up to 24 months of payment, so add up to 2 years right away. What we're seeing is that for people with what we call thin credit files, little or no credit history, at least 1 account, but fewer than 5 accounts in a credit report, an increase of about 19 points on average. For people with a more established credit history, we're seeing an average increase of about 13 points. And when you first enroll in Experian Boost, we'll give you, as you start the process, a credit report and a FICO 8 score. And when you complete the process, we'll give you another score so that you can see what the impact was. 2 out of 3 people tell us they see an improvement at this point. So it can be a great way to get started if you're trying to build credit for the first time. I will say If you have a long credit history, it's a strong credit history, have very good credit scores, Experian Boost isn't likely to do much for you, if anything at all. I did enroll in Experian Boost and made no change to my credit scores because I already had a history that offset any of those things that would have been added. And so it wasn't beneficial. So we spent 3 or 4 years developing Experian Boost to make sure that it did not wrongly skew scores upward or downward. So it reflects a potential that a person's a better credit risk than it might otherwise be. So if you're interested, check out Experian Boost. It's a great way to get started, especially if you're trying to build credit or you've had some issues in your recovery. It's also valuable for people who are new to the country. We know that there are about 28 million credit invisibles in the US, meaning they have little or no credit history. We know that communities of color are more adversely represented. More than 26% of communities of color, Black and Hispanic consumers, are unscorable or have thin credit files or are credit invisible. We know that there are about 4 million consumers who turn 18 every year and are beginning to build credit and need a tool to access that information. And about 20 million consumers, pardon me, who are between 18 and 23, so young and unlikely to have a very established credit history. We also get 30,000 telephone calls a month from people saying, hey, I want to establish credit, through no marketing, no outreach on our part. So people are looking for ways to build credit. Experian Boost is a way to help you get in the system if you aren't there. Having a credit report is incredibly vital to being financially successful. And that's what we want for people to do. So Experian Boost can help do that. If you do not have a credit history at all, if you go through your phone or mobile device to the Experian app and begin to enroll, it's a free app, and you do not have a credit history with you, we have something we call Experian Go that will help you create a credit report that is essentially blank, except for your identifying information. So we'll ask you for some identifying information. We'll ask you for a live selfie, and then create a credit report for you with just your identifying information. From there, you can add the Experian Boost information. We've seen people move from no credit history at all to a FICO 8 score of around 630 in a matter of 15 minutes or so using Experian Go and Experian Boost. So get you on the map. It's not a great score, but it moves you in the right direction. That's what's so really important. And will then help you qualify for other types of credit over time that can help you build that credit report. So consider those. I won't cover everything here in the interest of time because I want to get to scores and a few other things, and I've talked too much as usual. But if you find something you believe is inaccurate in your credit report, you should most definitely initiate a dispute. It's free, doesn't affect scores, and so you should definitely do that when you dispute. The easiest and safest, most secure way to do that is online. So you can go to experian.com/dispute and follow the instructions. If you don't have a current copy of your personal report, we'll give you a free one there, in addition to the other ones you can get through annualcreditreport.com and other sources. So we'll give you a free report, and you simply follow the steps. So there's a button by each item. You can say, I need to dispute this. You click that and we'll walk you through. So what is it you need to dispute? What's incorrect or what's wrong, and walk through that process. And then you hit submit, like a shopping cart. Really easy to do. We'll go directly to the source, just like we would if you sent us a letter or called us on the phone. You can write, you can go on, can call. The thing that's most important here is the dispute must be specific. You need to tell us exactly what's wrong with the particular item. So this account is not mine, for example, or this account is fraudulent. Be very specific as to what the issue is. It's very helpful for us to be able to dispute effectively for you. You should allow 30 to 45 days for a dispute to be processed. That goes back to when we mailed things back and forth with paper. Today, most disputes are completed in 10 to 14 business days. We go back to the source. The source is then required to verify by federal law the information in their records and either tell us in response that the account should be updated in some way, it should be removed, or it should remain as it is reported. And we will then send you a report on the results of the dispute. If you disagree with the results of the dispute, you should add what we call a statement of dispute to your credit report. Again, it's free. It says, I disagree with the result of the dispute. Here's why. And anytime your report is then accessed, or requested, we notify the entity requesting that report of that statement. They should be able to see it and respond to it. It's also important to understand that when you dispute something, if there is a change made by the creditor or the source of that information, that creditor is required then to make that same update to any other consumer reporting agency it reported the information to. Experian does not go to Equifax or TransUnion and tell them to update the accounts. That's up to the creditor. And the reason is we don't know if they've reported it to all of the bureaus or just one of us. We don't know if it's reported to other kinds of consumer reporting agencies. Only the creditor knows that. And so they're required then to go notify anyone they shared that information with of the change or the update. And so that's why I recommend if there is a change as a result of a dispute, check your other credit reports too, just to be sure that the update's been made. It might take them a bit longer. So, give it a few days or, a month. Again, that 30 to 45 day thing, and you'll be able to make sure that it's there, but go to them and also verify. So we've talked about disputes and information in a report, what's there. How long does it remain? Well, the good news is we keep the good news, the good stuff longer than the bad stuff. So open accounts in good standing remain indefinitely. Closed accounts in good standing remain for 10 years from the date of the closure. So the date it's reported closed. So we keep closed accounts that are positive for 10 years. Late payments remain for 7 years from the date of the missed payment. So if you miss a payment is due today or reported today, it will remain for 7 years from today and then come off the credit report. Collection accounts remain for 7 years. This gets a little more complicated. It remains for 7 years from what we call the original delinquency date of the original account. So if you have an account, you fall behind today, you never catch up, the account's charged off as a loss and then sold to collections. 7 years from today, the date the account originally became late, is when that original account and the collection account will be deleted. We treat a collection account as a continuation of the original debt. The thing that makes it a bit complicated is that if you have you bring the account current between late payments, that changes the original delinquency date. So if you miss a payment today, this month, next month you catch up, and then the following month you fall behind again and never bring the account current, you would see the first late payment fall off, and then a month would pass, and then the account and the collection would fall off because you were never again current in that string afterward. So keep that in mind. Be a little bit confusing. Chapter 7 bankruptcy remains for 10 years from the filing date because you do not repay any of the debt. Chapter 13 bankruptcy remains for 7 years from the filing date because you do repay part of the debt. So it comes off a bit sooner. And inquiries remain for 2 years, even though they really only affect credit scores for typically 2 to 3 months, because by that time there's either a new account and that's the strong risk indicator, or there is no new account, so the inquiry doesn't represent new debt, so it doesn't represent risk. FICO says that they omit inquiries after 12 months entirely. So they're there for 2 years, but they really don't affect scores for that long. So quickly, one more poll. We'll see if anybody wants to jump in and answer today. Which of the following is not a credit myth? A, when paid, the bad debt goes away. B, a person can have a 900 credit score. C, a consumer must give permission for a report to be issued. Or D, the credit bureaus are responsible for choosing who gets credit. Which of those is not a credit myth? Anybody want to guess? We'll just give it a few seconds. Nobody jumping in. So we'll give you the answer. The answer is, my mouse will work, is B. You can have a 900 credit score. And that's a huge misunderstanding. Usually a surprise to a lot of people. People hear about the 350 to 850 scale and think that's the only one. In fact, that's not true. And I'll come back to that in just a second. I want to touch on just a few of these myths before we move to scores. And I'll just hit the corners because they're kind of the important ones. When paid, a bad debt goes away. It doesn't. Your account's updated to show that it's been paid, but the history will remain according to those timeframes I just shared. So it would show paid was 60 days later, 90 days later, 30 days late, for example. A divorce decree separates joint accounts. It doesn't. This is a really difficult time in some people's lives. You're angry and upset, and you go to the court and you agree as to who's going to pay which bills. And that's just an agreement between you and the court. It doesn't break the contracts with the lenders. You have to go back to the lenders and they have to agree, and they might not. For example, with a mortgage, huge debt for most of us, you both are co-signers because it gives them more security. They may not agree to remove you from that mortgage loan, which means you would then probably have to either sell the home or refinance in some way, that sort of thing. But a divorce decree does not break the contracts with the lenders. That's an agreement between the divorcing couple and the court. You must give permission for a report to be issued. You do not, with the exception of employment purposes. You must give written permission first for employment purposes. Most of the time you do. If you read the fine print in an application, it says somewhere in there that by signing the application, you're giving us permission to check a report, but you don't have to do that. Pre-approved offers are the common example. And there's only one credit score, and it's on every credit report. In fact, there are hundreds of different credit scores. They are not part of a credit report. They are a reflection of the information in that credit report at the instant it's requested, but they're not part of the credit report. So that brings us to credit scores, and the thing that people often want to talk about: how to make my credit score better. Well, first you need to understand what a credit score is. And a credit score is simply a tool that's used to evaluate the information in a credit history to help a lender predict risk. The way I think of it is sort of like a school paper. So as a student, if you write a paper, that paper is like the credit report. You determine what information is in it. You turn that into the teacher, it's like applying for a loan. The teacher's like the bank. They're going to decide whether or not that information is good or bad. So they're going to grade it. The grade is like the credit score. You can't change the grade. If you ask a teacher and they give you a C, you can say, I want an A. They won't change it. The only way to change that grade is to change the paper. Same thing's true of credit scores. If you have a credit score, you want it to be higher, you have to change the paper. You have to change the credit report in order to make those scores better. And you can do that. Credit scores are a valuable risk management tool. They are very accurate in predicting the likelihood a person will not repay a debt as agreed. There are many different models or formulas from different sources with different scales. There are different scores for different types of lenders. So credit unions have a certain kind of customer, and their customers have certain characteristics and financial behaviors. And so they have scores that will reflect that customer base. National banks have different kinds of customers. And so they have scores developed based on their customer experience to help them predict risk for their customers. So one way there are different scores. The other is that there are different types of lending. So if you're buying a car, they have scores for auto lending. The FICO score for auto lending goes to 900, not just 850. So if you want to win a bar bet, check your FICO auto score. It might be more than 850. So different scales for that. If you're getting a credit card, they're trying to predict the likelihood you'll pay a credit card on time. So they have a different kind of score. Mortgage lending, or buying a house. So they have different scores for mortgage lending to determine the likelihood you'll pay that home loan is agreed. So there are lots of different scores. There are 3 different credit reporting companies. You only have 3 credit reports. All credit scores use information from the credit bureaus, from the credit reports, to do the calculation. Our role in credit scoring as a credit bureau is pretty limited. We may apply a credit score, meaning when your credit report's requested, so they ask for Rod Griffin's credit report, we might compile that, or we would compile the credit report. And if they said we want a FICO 8 auto score, we would route the report through that score. There's about 250 scores, I think, that reside in our systems, meaning FICO is basically renting space from us, and Vantage Score and some others. And we can compile a report. When a lender tells us which score they want applied, we'll route it through that score. And we send the report and the score in parallel together to the lender, and the lender can say, when I get the credit report and score, I want the identifying information from the credit report to show on the screen first, and then I want the scores, and then I want the rest of the report. So it looks like the score is part of that report, when in fact it's not. It's a separate process from the report. Scores might also be calculated by the lender after they get your credit report, so the credit bureaus aren't involved at all in that calculation. And if you're buying a house, there are what they call third-party mortgage reporting companies. They get your credit reports from the 3 bureaus and a number of information from your applications and other sources, and then they will apply scores and send all of that information to the lender. And so we wouldn't be involved in that instance either. So scores may or may not be part of the service we provide. So knowing there are lots of scores with lots of different scales, how do you know what to do to make them better? Well, it's pretty simple, really, and it's based on something that people don't often know about. Even though the scores can be very different. And if you get 2 or 3 or 4 different scores, your numbers that you get are probably going to be different. But if you get the risk factors that go with those scores, which every time a score is calculated, a series of risk factors are generated that describe what from your credit report most affected that score, you should get those risk factors when you get a credit score, as along with the scale that the score's from and an explanation of what that score means in terms of risk. Those risk factors tend to be very consistent from one score to another. They'll tell you exactly what from your credit report you need to work on to make your credit score, that score better. And because they're consistent, it will make all of your credit scores better. So focus on the risk factors, not the number. The number is helpful to know in general terms of where you stand in terms of risk. The risk factors empower you to act and to know exactly what you need to focus on in your credit report. So check your risk factors, use those to formulate a plan to help take action that will improve all of your credit scores. Get those risk factors. They're what are really empowering. I won't belabor you with an answer or giving me an answer, but which of the following is not a credit score risk factor? Credit utilization, the balance of your checking account, your payment history, or how long you've used credit. Well, it's the balance of your checking account because we don't have that information in a credit report. The rest we do, and they all affect credit scores. This is from VantageScore 3.0. I call it their donut. There's also a similar one for VantageScore 4.0. You'll see a pie chart from FICO. The percentages look very similar. Payment history will always be the most important factor in credit scores. You must make all of your payments on time every time to have good credit scores. Late payments are going to wreck your scores. So you have to make those payments on time. Utilization, or your balance to limit ratios on your credit cards, are the second most important factor in credit scores. VantageScore breaks it out a bit differently. They look at utilization in total. So add up all of your balances and all of your limits for all of your credit cards. That's going to be somewhere in the neighborhood of 20% of the score. And then they look at the balances on individual accounts. So that's another roughly 11% of your balances compared to your limits. My math says that's 31% of the score. So utilization is about 30% of the credit score. You'll see a similar number for FICO scores as well. So the bottom line is, if you pay your bills on time every single time and you keep your credit card balances low, you're going to have good credit scores. You have to do those two things. That's going to be somewhere between 60 and 70% of a credit score for most people. Other things build on those two things. So how long have you used credit, your depth of credit, how long you used it, what's your mix? You have different types of credit in your credit history. What does recent credit behavior look like? So have you applied for new credit or the new inquiries? Have you paid something off recently? Have you taken on more debt recently? And in terms of credit reporting, that's recent is usually 3 to 6 months. You look at what's happened in recent history. And then available credit, what's your overall capacity? That kind of wraps up the 100% with that 3%. So pay your bills on time, keep your balances low. You will have good credit scores. Time is essential. You can't fix a number. You have to change the information in your credit score. There's no silver bullet. If you address the risk factors over time, your scores will get better. Depending on the severity of the issue, they might get better faster. So bankruptcy is going to take a long time potentially. If you just missed one payment, never had any other issues, talk to your lender. They might waive that late payment and remove it from the report, and your scores can get better right away. If you catch up right away, scores are probably going to bounce back up. So time is essential. And with that, I'll talk just about a few resources. Where do you get your report? Well, you can enroll in experience-free monitoring service. If you would like to do that, you get a free credit report and free FICO score once every 30 days. You also get monitoring and alerts if there's any changes to that credit history that can indicate fraud, for example. And you get nice things like offers for credit cards or loans. You can always say no. I say no a lot. That's my one perk is I get our monitoring service. So it can be a useful tool. You get a lot more information than you would if you get it through annualcreditreport.com, what we call the centralized source. You can get a free report at annualcreditreport.com once a week. The law says once a year. By policy, we've changed that to once a week. So you, in theory, could get 156 credit reports a year free through annualcreditreport.com. Does not include a credit score, but you will get a full report and the information you need there. So another great place to get credit scores. No reason to pay for a credit report. If you exhaust all of the free reports you can get, I think they're $13.75 now, but I haven't talked to anybody who's paid for a report for 8 years, maybe, or longer. So get a free report. Know what's in that report. It's going to be really important. We also have a number of resources available. Join us on, actually right now, my team is doing a credit chat, just wrapping up, just like I am. But join us on Twitter, now X. We've been doing it since 2012. They have all sorts of great guests talk about lots of personal finance issues, not just credit and scores. And at Experian.com, you'll find lots of great information as well. If you go to Experian.com/consumer education, you can find a version of this presentation, as well as a number of other education resources. And with that, Lena, I'll stop talking and answer any questions anybody has.
Okay, thank you, Rod. We'll go ahead and open our Q&A now. If you have any questions, go ahead and enter them in the Q&A box now. And we'll go ahead and just give you a minute or two to type those questions in. Is it better to open more cards or have fewer cards with higher limits?
Well, and the answer is, with like every question about credit, it depends on your circumstance. You don't need lots of cards. 1 or 2 credit cards are sufficient. Now, we always recommend that you have 1 credit card. And the reason is that credit cards give a little bit better insight into how you make lending and repayment decision, or borrowing and repayment decisions, because of what I think of as free will. You can decide how much you're going to charge each month and how much you're going to repay with a credit card, and you can decide whether you pay the balance in full, the minimum due, or something in between. And so that can help build scores a bit quicker. So 1 or 2 is sufficient. And really, it's about how you're using the credit you have available. So if you have an account with a $500 limit and you're paying the balance in full and not carrying, so you're keeping a low utilization rate, you're making a small charge, $10 or $20 a month, and paying that off. That's going to be just as effective as a person who has a credit card with a $10,000 limit, but they're maxing it out and then only paying part of the balance each month. So it's about how you manage the credit you have available to you, not really about how many accounts you have or what your credit limits are. It's how you're managing them.
Thank you. It doesn't look like we have any other questions, so that concludes our webinar today. Thank you all for attending, and I hope the session was helpful to you. As a reminder, we will be sending you a follow-up email with today's presentation. Have a great day, everyone. Thank you.